Now, when do we use debt? When do we use equity as a source of funding? Now, both have pros and cons, and let's go through them one by one. Debt, debt financing, when you use debt financing, you're becoming a debtor and the investor is a creditor. So there is no ownership involvement. You keep full ownership. Once you pay down the debt, there's no more obligation to pay afterwards. You can end the relationship there. The interest payments are tax deductible. You can choose whether to borrow long term or short term, which could result in more cash on hand. Equity financing, on the other hand, doesn't have the risks involved when it comes to debt financing. So it's considered from the perspective of the issuer, it's lesser risk compared to debt. There is no commitment to pay back, especially for common shares of stock funding. Preferred shares, some preferred shares have been issued with a timetable to pay back. But for common shares or even retained earnings financing, there is no payback of funds. We also gain credibility through the investor network because when more people invest through the equity side rather than the debt side, means more people are willing to take on risks on the viability of the business long term. Some investors don't immediately expect return on investment, although at some point you still have to satisfy them through dividends or if you go into an IPO. From a private company going to an IPO, that's one of the ways wherein early investors get to monetize uh, their initial investments. Also, fixed payments for better budgeting. Equity financing will allow you to effectively control the payments outward. Let's say on dividends, you'll only budget for dividends if you foresee you're going to declare them. If there is stock buybacks, it can be scheduled as well. Unlike in debt financing, fixed yun, you're now committed to the timetable promised within the contract. Now, kung may advantages, meron din disadvantages. Debt financing, as mentioned, you have to pay them back based on schedule. Could cause cash flow issues, especially if your inflows do not match the outflows. And some would be requiring collateral for them to proceed with granting you the terms that you may want. So, maraming additional requirements when you pursue creditor relationships. Equity financing, investor returns could be more than that. Actually, that is the point of equity financing or equity investors. They could limit their risk by fixing the cash flow exposure to you through debt financing. But since they are willing to be exposed to your business viability long term, they expect more in exchange of that. And investors in the equity side have ownership rights, especially for common shares. So at times they may be involved through the board of directors or voting outright. And also for certain corporate decisions, although debt financing, mga creditors would put in place covenants wherein to protect them for adverse corporate decisions. Pag equity financing, every year may annual shareholders meeting. Kailangan mo makapag-usap talaga sa kanila at least annually. Wala kang choice. So as a recap, money markets could be split between short-term, long-term. Capital markets, especially on equity side, they are long-term in nature because most of them don't have or have indefinite maturity timetable. So bonds could either be fixed, floating, coupon, or convertible. Equities could be shares, equity linked, or even derivatives.